even in the market we were at 6 months ago, let alone the one we're in now, stress test your deals, add an extra point or two onto the analysis, make sure it still cash flows, and make sure that, and so there's a few lenses for those that have a portfolio. Analyze that portfolio against the changes that are happening right now. And for those that are still shopping, whether you have a portfolio or you don't, absolutely stress test your deals, make sure that it's going to continue to stay a strong asset on its own as an individual asset, but also within your portfolio if you do have one, because it's very important to differentiate those two lenses. We always want to be analyzing a deal, but sometimes we'll make an exception on a deal if within the portfolio it makes a ton of sense.
Okay, Chris, there's kind of three areas that I kind of want to cover. Kind of what the current, what's the state of the current market? How do you see that? Where you see interest rates going, and then what are the approaches that are going to make sense for people in terms of real estate investing? So perhaps let's kick off with the current market. What's happening right now, and let's kind of follow on from that. Where do you see things kind of heading over the next 3, 6, 12 months?
So, I mean, in terms of what's going on right now, I would segment it into a couple of different categories. There's what's going on in the market, and what does that mean for buyers and sellers and investors. And then there's what's going on with people personally. And the two are, as much as we want to separate personal from business, they're, it's undeniably linked. And so when we work on one, it feeds the other and vice versa. And so on a personal note, there's a lot of stress and fear, and sometimes leading, bumping up against panic. And I think, it's worth reminding ourselves, and I do a bunch of these conversations and consultations with investors as well. When is a good time to panic? Well, pretty much never, right? Like it's never, of all the good things that have happened over history, how many came from panic and how many came from calm, cool, rational thinking? And that ratio is obviously very lopsided in favor of calm, rational thinking. And so, and the other thing that we can remind ourselves of is, everything in the world is in a constant state of adaptation. We look at the pandemic, the real estate market right now. The real estate market 6 months ago was adapting. It has adapted again over the last 6 months. And the lesson there is that change is inevitable. And so over the last years, what we're talking about is prepare for the change. Don't fear it. Don't think it might happen. It will happen. And so prepare for it and plan for it. And it's no different now. Like the lesson we can take from that is we should adapt, right? The market just changed again. So we're in a constant state of adaptation. This isn't something to fear and be paralyzed over and kind of hesitate and analyze to death. It's changing. We should move more fluidly with it and capitalize on a bunch of what's happening right now.
Right. And what do you think? What do you think warrants or makes up a good market right now? What are the kind of things that people should be looking at and pulling out the positive?
Yeah, for sure. Right. It's it's a time to reorient back to the fundamentals. Not that we should have ever lost touch and sight of those, but during a 6 month period, and seeing the change that we just had, keep tied and focused on the fundamentals, keep tied to your own personal why and what you're doing. So what makes this a good market right now for buyers? Well, the ratios are very good. So we're looking at purchase to rent ratios. We're looking at the delta between and these conversions, right? These single family homes converted to duplexes and ADUs and the hybrid method that we've been talking about now for a number of months. We're looking at, what's the delta between purchase and ARV when we're doing these conversions. And right now, in specific markets, especially, the ratios are extremely good. Not only that, but the buying experience is exceptional. I should clarify, there's very good buying experiences out there to be had. There's also a lot of variance in the market right now as sellers try to wrap their mind and get their head around the psychology of, I want to sell right now, but the market's not what it was 6 months ago. So where exactly is it? Sometimes the buying experience can be a little more unpredictable. But largely, a lot of the buying experience is quite good right now, meaning, you have the ability to put conditions in, right? Which is something pretty nice for people.
Right.
We can have, multiple conditions, appraisals, inspections, finance. These things are now allowed because the market has become more balanced. Not only that, but there's not 20 offers, two are related but different, not 20 offers to compete against, and that complete feeding frenzy that was happening before. It's not a good buying experience, nor is it sustainable. So very, very good opportunity right now, for the buyers especially.
Right. I've been seeing some media headlines kind of highlighting certain markets in the GTA that they are saying, is the overpriced or super expensive. What are the markets in the GTA that still make sense from a real estate investing perspective?
Yeah, so for myself and for my investors, we're focused on markets, just an hour outside of the heart of Toronto, still in the GTA. That's large, not exclusively, but that's a big part of the focus. And so within those markets, east, north, and west, I separate them into primary, secondary, and tertiary markets. And I want to be very careful, as each time I say that hierarchy, it's really not a good, better, best. They're just different. Each one comes with its pros and cons. Each one behaves differently in the bull market we were in 6 months ago, and in the changing market we're in now. They just behave differently. And that's a good thing, right? Because investors can now, when we're able to do knowledge transfer on the pros and cons of each of those three tiers, now investors can pick the one that fits them the best. And that's a very good thing. And so right now, there's a really good opportunity in the secondary markets. And we've been talking about this for a lot of years. The markets behave differently when there's a correction. And so tertiary markets tend to correct first and recover last. Now, that doesn't mean they're bad, because the price points are very good. The barrier to entry is very good. The inventory tends to be higher. The land sizes tend to be bigger. So this isn't a knock against tertiary markets. It's just something you need to know as you engage with them. Now, the primary markets are more insulated against corrections, not entirely, but more so. And so the secondary markets right now are sitting in that sweet spot, which they tend to, which is creating a very good delta between the purchase and the ARV. Again, in these conversions, they also sit in a sweet spot in between tertiary and primary in the inventory and the land size. And so markets like Brantford, Peterborough, secondary markets like those are especially good as a point in time right now.
Right. Okay. So moving on to interest rates, obviously they're going up, and we're seeing what's happening. The US has just announced, again, it's likely to be going up significantly and continue to do so, which shocked a lot of people, I think. Where do you see interest rates? We've got an announcement coming up fairly soon. Where do you see that happening? I think we're all expecting that to go up, but what about beyond September? Where do you see it going?
As a general rule for myself, I try to be very careful in differentiating between things that we know and things that we're, theorizing on. And so this one, nobody has a crystal ball, right? So just for my own kind of conscience, I always try to clarify that. So where do I think it's going to go in terms of probabilities? The word from, the larger banks, as of a month ago, 6 weeks ago, was that the overnight rate is at 2.5. They were going to try and get the overnight rate up. Their theory on what was going to happen is that the overnight rate was going to be raised up to 3.5 by Q1 or Q2 of 2023, at which point they would leave it sit flat for 12, 18 months, after which point it would start to drop. That was the sentiment, 4 or 6 weeks ago. Today, though, as we've seen inflation start to pull back, at least the beginning signs of it, I've seen some indicators from the larger banks again that the inflation tends to lag behind interest rate adjustments. And so the sentiment in what I've seen coming out from the larger banks is, we might think about not going to 3.5. We might go a little less than that. And because this, the impact on inflation is going to continue, even with the 2.5 overnight, it's going to continue to decline is the prediction. And so they're saying we might not see this 3.5 in Q1 or Q2, we might see another half point before the end of the year, at which point then it would stabilize and sit flat and then start to decline. Now, will that happen? I don't know. The announcement from the US would tend to say maybe there's going to be, a full 3.5 coming. I mean, I should clarify, I don't mean a full 3.5 increase coming. I mean from 2.5 to 3.5. That might be coming. So my prediction, very short term in September, I think, if I had to guess, a 0.5 increase. After which, I'm not sure. We'll have to see what plays out in the fall and how inflation is responding. But largely, I mean, that's some conjecture around what I think and probabilities. But the more macro takeaway from that is that this is not a permanent adjustment. This is, even by all predictions that we have right now, whether it goes from 2.5 to 3 or from 2.5 to 3.5, by all predictions right now, this is an adjustment after which it will start to drop again, which we've seen in the past. So that's, again, fuels that theory and probability. And so again, for investors, plan to that. There's no guarantees, but these things ebb and flow. And so this is not a permanent state. This is more a point in time for which we need to navigate through and continue on.
And does it make sense for investors to kind of factor in that slightly higher rate when they're doing their numbers, when they're looking at the cash flow versus what's sitting here right now, or even another 0.5%?
Yeah, absolutely. I mean, even in the market we were at 6 months ago, let alone the one we're in now, stress tester deals, add an extra point or two onto the analysis, make sure it still cash flows, and make sure that, and so there's a few lenses for those that have a portfolio, analyze that portfolio against the changes that are happening right now. And for those that are still shopping, whether you have a portfolio or you don't, absolutely stress test your deals, make sure that it's going to continue to stay a strong asset on its own as an individual asset, but also within your portfolio if you do have one, because it's very important to differentiate those two lenses. We always want to be analyzing a deal, but sometimes we'll make an exception on a deal if within the portfolio it makes a ton of sense. Meaning if my cash flow is tighter than I'd like it to be for this deal, but my portfolio can handle it, and there's a bunch of future opportunity within that deal where the cash flow is tight just today, well, we want to look in a bit broader sense. To your point, we do want to stress test that deal on its own, but then also within the portfolio and make smart decisions based on that.
So it might be, for an example, it might be a duplex conversion, but there's big opportunity for an ADU. So it might be a bit tight with the 2 units, but once you go to 3 or maybe even 4, then you're making it work. Right.
Absolutely. And this is the beauty of this hybrid model that we've been educating on over the last 12, 18, 24 months, is that in the market that we were in, which was more predictable but less sustainable because it was increasing so aggressively, ADUs and that future opportunity, that hybrid model made a ton of sense. Now fast forward to today, it's the same benefit for that strategy, because we still want to see that upside sitting there with that ADU possibility and predictability coming from that. Now the interest rates, the purchase prices dropped, the interest rates have gone up, the cash flow remains as strong or stronger in these secondary markets in particular. But the benefit of this hybrid model that we've been talking about is as strong today, just for different reasons, as it was 6 months ago for other reasons.
Right. And just the banks, just for a second, we're also hearing stories of banks refusing financing right at the close. There's been some stories around a couple of the big banks doing that. Does that force investors to look at private money and therefore more expensive, or is it just a case of shopping around and finding those good relationships and building those good finance relationships?
Yeah, I mean, I would say primarily my recommendation, and I'm a big proponent of this across everybody, every function on your power team, make sure they're one strategist, not tactical, unless that's what you explicitly need as somebody who's strong tactically. Strategic partners in that respect are very, very good, but also that specialize in investing. And so this goes straight to your question. So I recommend working with mortgage brokers in this case, that are strategic and specialized in investing, because they have the view across most of the A lenders, but they can also go to B lenders, private money, hard money. They can see across the breadth and depth better than anybody else in terms of the options for lending. And now, what does that mean for buyers and the scenario you raised around closing? I mean, always have a plan A, B, C, D, like make sure you've got backup plans. Because in changing markets, right? And I recommend this to people now, but especially over the last 6 months, do a quick close, because what we don't want is a long window of closing where we get it appraised during, the conditions, the first 5 days of locking up the offer. And then you've got another 60, 90 days sitting there for the market to do what it's going to do and the interest rates to maybe change. And then the lenders ask for another appraisal closer to closing, and it turns your deal upside down potentially, right? So make a quick close so that it's your business continuity model is more protected. It's more secure. So you can get in and out and get the deal done faster with less variance and less risk.
Right. I think that's a great tip. That's great advice. So looking forward, what are the approaches? We've been talking about the hybrid model, which sounds like that's still something that makes a ton of sense in the market, even if interest rates go up a little bit or the market prices go down.
Mm-hmm.
Is that the primary approach that you're recommending, or are there other approaches that make some sense for some people?
During these times, a time of change in the market, and specifically with interest rates, there's a couple of things to focus on. When you look across different investment strategies, wholesaling, flipping, RTOs, longer term holds with a BRRRR, apartment buildings, there's this continuum of options out there in the investing world. And those with a shorter time domain tend to be less favorable during times like this. So think flipping, for example. I don't want to get into a project that has a finite time domain, call it 6 months, 8 months, where the volatility is higher in the market right now. I would rather see the volatility, like, fast forward to, let's say they go to a 3.5 in the overnight. Fast forward to there. Now think about flipping when we're either in a stable state or an inclining state. That's the market that you want to re-engage in flipping in. But in a declining market, a changing market, be very careful with a project that has a finite time domain. Now, conversely, we can look at projects like the hybrid model, conversions from singles to doubles and triples with the ADU. We can look at those for two reasons. One is the time domain is much longer. Two, they cash flow. And so we have now the option to continue to employ this methodology and not worry so much about, it's not that it's irrelevant, but it's far less critical path for the success of the investment as to what's going to happen in the next 3, 6, 9 months. We've got a much longer term strategy and operational plan for those types of assets that is going to weather that storm far more favorably.
Right. Now, you do a lot of conversions, and with your partners you do as well. What are you seeing from materials point of view? Because we saw this at the beginning of COVID or during COVID, the cost of resources and everything just skyrocketed, and then you couldn't get hold of it. Is that stabilizing? Are there still expensive things that are happening, or what's the latest on that?
Yeah, I mean, from a contracting standpoint, from a renovation standpoint, maybe better said, yeah, we still are experiencing super high demand for contractors. Now, I think that's waning a little bit, but we're in the early cycles of that, so it's a bit early to tell. And it came in a few different flavors. The amount of activity, the amount of building created a big shortage of contractors, which increased their demand quite a bit, which increased their prices a fair bit. That was a variable all on its own. And then introduce the pandemic and everything that's happened over the last couple of years. It also put strain on labor, finding labor, securing labor, keeping them on site by the activities with the pandemic. And so those three variables were all challenges, overcomable, right? We did a lot of renovations through the pandemic successfully. So this is like anything. There's always ebbs and flows, and there's always logistics that are changing, and then we have to adapt and overcome with. This is one of them. So very solvable, but challenging. And right now, to your question, I think we're seeing material prices stabilize a little bit better. The overall contracting and renovation experience is a little bit better. And I think we're going to see that trend stabilize and not keep increasing at the rate that it was. Now, that raises why do I say it's going to stabilize and not decline? Because everything that's going on, right, especially in the GTA, it's broader than that, but let's just talk about the GTA. Everything that's going on right now is almost details, right? Like the interest rates and the price changes, they're very relevant details, but they're details on top of a fundamental issue, which is supply and demand in the GTA.
Right.
That supply and demand is not changing. And so that's why as I'm saying, contractors will, and the engagement with renos will continue to stay a little bit of a challenge. It's because supply and demand isn't changing. We need more housing. And so I don't think this landscape is fundamentally changed underneath. The details on top, the interest rates and the transactions of today have changed a little bit, but the fundamentals haven't.